Okay, so the financial media, they're glued to the daily price swings, right? Watching silver maybe dip lower. But there's this one voice, one of the most respected resource investors out there saying, ignore the noise. He actually sees this recent crash, this volatility, not as some kind of defeat, but he calls it a cleansing fire, necessary. He genuinely believes the real historic move in silver, it's only just beginning now.
Yeah, that's right. We're looking at the latest analysis from Rick Rule, the resource legend, and he's been incredibly clear, hasn't he, saying the short-term pain is basically designed to liquidate, to wipe out, as he puts it, those traders who got in late, especially was using leverage. And crucially, this is happening just as the disciplined long-term investors are, quietly getting into position for what he sees as the next big leg up, the really aggressive part of the run.
That really is the ultimate counter-narrative, isn't it? So Rule's whole argument is that this volatility, it's not a market failure, it's actually a feature. These huge short-term swings, they're resetting the emotional temperature of the market. So the big question for us today, using his direct insights, has to be, what are the real, maybe the hidden drivers of silver prices? And why does Rule specifically warn that, quote, you cannot afford to be late?
Right, and we're going to examine the exact mechanisms he's pointing to, things like these catastrophic warning signs in the physical borrowing rates,
Yeah.
and also the complete enigma surrounding just how much silver is actually out there in the world. Look, this is really crucial if you want to understand how market psychology and actual physical tightness can combine to create these explosive price moves.
Okay, so before we really unpack all this essential info, get into the core thesis. If you value getting knowledgeable quickly, understanding these big macro forces in resource markets, just make sure you're subscribed. Okay. All right, let's get right into this volatility reset idea.
Okay, yeah. Let's unpack Rule's core message about the short-term price action. His view is, well, it's incredibly counterintuitive for the average trader focused on the day-to-day. What Rick Rule said recently is that a significant drop, I mean, even a severe one, like silver moving from $50 down towards $40, wouldn't actually derail the long-term precious metals bull market. Yeah, not at all.
But that kind of move, surely that causes widespread panic. You hear cleansing fire, but doesn't that risk scaring off even the disciplined investors too? How does he tell the difference between the weak hands getting fleshed out and the long-term holders maybe getting spooked in the heat of the moment?
Well, that's where silver's nature comes in. It's what they call a high beta asset, right? Meaning it's super sensitive, highly leveraged to overall market sentiment. So when the market moves, silver tends to move more violently up or down. Rule says the price action is specifically taking out the leveraged momentum junkies. The people who got the religion of silver in the last 4 weeks, as he put it, and are trading on margin. See, when you're leveraged like that, a sharp drop, maybe 15%, forces you to liquidate. It clears the decks of those emotional short-term players.
So destroying those leveraged positions is actually a necessary step before the next move higher can really take hold.
Precisely. And this leads straight into his powerful advice on timing. Rule really emphasizes that silver is such an emotionally charged asset. Trying to perfectly time the bottom is, well, it's just foolhardy. He says it unequivocally. Silver pays so much rent when it moves that you can easily afford to be early and you cannot afford to be late.
Mm-hmm.
Being early might mean you sit through a dip, yeah. But being late, that means you miss the eventual, often extremely fast, violent move where the real fortunes are made.
Okay, but this all hinges on what drives that price. Most people think silver, they think industry, right? Solar panels, medical uses, electronics. But Rule seems to dismiss that whole side of things. Photographic, photovoltaic, anti-germicide, water treatment. Why does he feel the industrial demand is almost irrelevant to the big picture?
Well, he argues that the sheer scale of investment capital just completely dwarfs the industrial demand figures. What generates the real price moves, he insists, is purely investment demand. It's the delta, the imbalance between buyers and sellers in the tangible asset market itself. Industrial users, they're relatively inelastic consumers. They need the metal, they budget for it, sure,
Right.
but they don't typically buy or sell in volumes large enough to cause those extreme price swings we see.
And he has a great story that really backs this point up, doesn't he?
Oh, absolutely. He often recalls this massive, really rapid silver price spike. And the key thing, it happened right in the middle of photographic demand, which used to be one of silver's biggest industrial uses, basically vanishing because of digital cameras.
Mm-hmm.
That spike proved, pretty definitively, that a surge in investment demand completely overrode a major fundamental decline in industrial use. So if global savers, or maybe funds, decide they want silver as a hard asset, the price is going to move violently. It doesn't really matter how many solar panels are being built that quarter. It's fundamentally a psychological and monetary thing, not an industrial one.
Okay, so if the psychology is so important, then we absolutely have to look at the physical constraints because that's where the investment idea gets, well, really reinforced. Let's talk about the strange structure of silver supply.
Yeah, this is one of the most critical and often misunderstood facts about silver. Unlike gold or, say, copper mines that are primarily copper mines, most silver doesn't actually come from dedicated silver mines. It's mined mostly as a byproduct, usually from copper, zinc, or lead operations. Which means, what's the implication there?
Well, this is the structural oddity that really feeds the volatility. It means soaring silver prices often fail to stimulate significant new production directly. Think about it. A mining company isn't going to start a massive new project just because silver hits $40 or $50 if the main metal they're after, like copper or zinc, doesn't also have a high enough price to justify the huge capital expense. You can't just turn the silver tap on and off based on the silver price alone, and that's what keeps the new supply pipelines so constrained and, frankly, unpredictable.
And it's not just new supply, right? The existing above-ground stock is apparently a total mystery. We have a decent estimate for gold. Roll mentions around 216,000 tons, give or take. But he says the total amount of silver already mined and held somewhere, it's one of the world's great unknowns. It's out there, but basically unaccounted for in market terms. And this brings us straight to that famous Warren Buffett example. Rule uses it often to teach about the dangers of trying to perfectly time this market or thinking you know all the variables. So Buffett, through Berkshire Hathaway, was believed to hold a huge chunk, maybe 15% to 20% of the world's known accessible market supply at one point. And this buying caused a spectacular price surge. Everyone knew who the big buyer was. It seemed unstoppable.
And how did that massive position suddenly get overwhelmed? What happened?
The surge ended, and ended violently, when the U.S. dollar suddenly doubled against the Indian rupee. And what happened then was the Indian peasantry, facing maybe a bad harvest or a flood, they needed cash. So they chose to sell their stored silver they held physically, like savings passed down generations. Rule says this supply, that basically nobody in the Western markets even knew existed in that form, suddenly flooded onto the market because local economic pressures demanded it. So this massive decentralized supply shock caused by millions of individual savers acting out of necessity completely overwhelmed one of the world's most powerful, sophisticated institutional buyers.
Wow, that is incredible. So you had this huge known institutional whale essentially drowned out, not by another big fund, but by millions of everyday people acting independently. That really crystallizes the sheer unpredictability of this metal, doesn't it?
It absolutely does. And that hidden supply, that potential for it to emerge, it just reinforces Rule's core thesis that silver is fundamentally a monetary metal, even if it's currently, as he kind of jokes, a monetary metal in drag, especially across South Asia, India, Pakistan, Bangladesh, Sri Lanka. For hundreds of millions of people who might be priced out of gold, silver acts as both a reliable store of value and, crucially, an informal unit of exchange in their local economies. It fulfills the classic definition of a monetary metal through practical use and ancient trust. And that ancient trust, that's its real underlying power.
Okay, hold that thought on the monetary aspect. Before we get into the immediate crisis signals flashing in the physical market right now, if you are finding this analysis valuable and you want more synthesis of complex markets like this delivered straight to you, just take a quick moment now to ensure you are subscribed. It really helps us out. Okay, so we've talked long-term structure. Let's shift now to the crisis that seems to be happening right now.
Yeah, this raises the really important question. What is happening right now that validates this whole squeeze thesis, this idea that the remaining leveraged hands are being forced out? To see that, we need to look at the frankly catastrophic signals coming from the physical lease rates.
Okay, for listeners who maybe don't follow the physical borrowing market closely, can you just quickly explain what a lease rate actually is and why a huge spike is such a crisis signal?
Sure, certainly. The lease rate is effectively the interest rate, the cost you pay to borrow physical metal, like silver bars, for a specific period. Now, historically, the normal cost to borrow physical silver, it's been pretty steady, somewhere between maybe 3% to 4% annually. Pretty low. Rule notes that recently in near-term contracts, that rate has just exploded. It's gone over 30%, even 35%.
35%. Just to borrow the metal, that sounds like a margin call on steroids. For anyone short or needing physical delivery, what's the mechanism of destruction there?
It is exactly that. It signals a severe physical squeeze, basically, desperate scramble for actual physical silver. And it's validating the reports of tightness in the reported inventories at key places like the COMEX in New York and the LBMA in London, the big exchanges for paper and physical contracts. Now, if you're a leveraged trader, maybe running 10 to 1 or 15 to 1 leverage on your silver position, if you suddenly have to pay 35% annualized just to borrow the underlying asset you're trading, your entire trading model is just obliterated. It wipes out all your margin, forces you to liquidate your position very quickly, pretty much regardless of your long-term view on the price. It's the market mechanism in real time cleaning out those weak leveraged hands.
Right. So the short-term pain is necessary. It's physically validated by these crazy lease rates. But the long-term metric is what keeps someone like Rule ultimately bullish. What is that fundamental metric he always points back to?
He consistently argues that in the long term, you absolutely must look at the utility of precious metals for savers relative to the utility of something like the U.S. 10-year Treasury bond. That comparison, that's the core macroeconomic driver in his view.
And what conclusion does that comparison lead him to right now?
Well, Rule argues that when the real inflation-adjusted return on assets that are traditionally deemed safe, like the Treasury, is negative or hovering near zero, then the fundamental utility of holding a tangible non-fiat asset like silver dramatically improves for a saver. Even considering its volatility, it becomes a rational flight away from financialized risk and the guaranteed depreciation of fiat money. And that foundational shift in utility is what makes him so fundamentally long-term bullish on precious metals generally.
And you really can't talk about this flight from dollar utility without touching on gold as well. Rule referenced Pierre Lasson's incredible, almost unbelievable sounding target for gold, didn't he? $17,250 gold by 2030. And that target, as Rule noted, isn't just plucked out of thin air. It's predicated on the US dollar losing something like 75% of its purchasing power over the next decade or so.
Exactly. And that's where the volatility factor, silver's high beta nature, becomes a massive potential advantage for silver investors. If the dollar does deteriorate as much as people like Lassonde and Rule expect, and Rule strongly believes it will, then the silver story becomes even more explosive. Why? Because silver's historical patterns suggest that its rate of price escalation could potentially double that of gold once it really starts to significantly outpace gold in a bull run. So Rule concludes that silver's emotional, its volatile nature, that's precisely where the fortunes are made, but only for the long-term, disciplined investor who's prepared mentally and financially to weather that initial storm, that cleansing fire.
Okay, so pulling this all together, what does this mean for you, the listener? Rick Rule's warning seems exceptionally clear. This short-term pain, it's not a failure signal. It's the market fleshing out the weak, over-leveraged hands. Meanwhile, the physical market is screaming tightness. Look at those astronomical 35% lease rates. And silver's unique monetary role, combined with its constrained supply, sets it up for what could be a truly violent, fast move once this reset is complete. Being early, he says, is affordable. Being late is not.
Yeah, the current drop from that perspective is simply a technical validation. It confirms the underlying structural tightness for anyone who needed to see it. This shakeout is seen as necessary preparation for the real escalation phase, which Rule firmly believes will be driven almost entirely by investment demand, not by industrial consumption trends.
Which leaves us with a final, maybe provocative thought to chew on. We know from that Buffett India story that vast amounts of silver exist outside the formal market system, hidden away in private hands in above-ground stocks, like the silver held by the Indian peasantry back then. Now, considering the market's general belief that this hidden supply must eventually come back onto the exchanges to balance the physical tightness we're seeing, how high does the price of silver actually need to climb before that hidden, unaccounted-for supply is finally tempted, or maybe forced, back out into the open market? That price level, whatever it is the great unknown that might ultimately define the peak of this entire cycle.
That is a fascinating question. Definitely something for anyone tracking future market movements and the whole idea of monetary utility to think about.
Absolutely. If you enjoyed this focused analysis of the silver reset and Rick Rule's perspective, please make sure you are subscribed. We release new syntheses of critical information like this every week.